Good Thursday afternoon, traders, investors, Finom Group members, our general YouTube audience. My name is Seth Golden. Welcome back to Finom Group's weekly State of the Market. I love this. I saw this on Twitter today and I had to get it for our State of the Market. Look at everybody lining up for signals, right? Because they're so reliable. And I mean, I'm being facetious here, but most signals we use in the market as technicians or quants because they have a track record and they lend themselves to forward probabilities in price action. So everybody lines up for the signals, but nobody really wants to learn anything, So this is just a great snapshot. Unfortunately, when it comes to a big part of the investor community. Jay Capil of Sentiment Trader coined it best. He says, everything you need to know about what separates the big winners from everyone else. Signals are sexy, exciting, and mysterious. Learning is hard work, same as it ever was. Not too many people want to learn. Not too many people want to do hard work. Everybody wants to make it easy, something that has good probabilities, that everybody's following, right? Quick way to profits everybody wants. But the reality is, that the real money is made by learning over time. All right, last week we talked, just kind of catching up on where we are in the market. Here Thursday, we do have a pretty good rally going on. We're starting to see some consolidation this late afternoon, but we also had some new 52-week lows here this morning. But last week we had talked about October tends to be a bear market killer. And this chart here from Almanac Trader shows you how many bear markets ended by month, and by far October has more bear markets end in that month than any other month, and it's for all the major averages. And the only reason why Nasdaq has fewer is simply because Nasdaq wasn't around until 1971. Here are the Dow Jones. These are the years that the Dow Jones bottomed in October, S&P 500 years that it bottomed in October, and the Nasdaq years that it bottomed in October. And you can see Nasdaq bottoms in October start in 1974 versus the other markets, 46, 57, keeping in mind that the S&P 500 wasn't the S&P 500 until 1957. All right, so coming into the week, we weren't anticipating, very good things to happen in the market based on the technical setup. Within our weekly research report, which comes out Sundays, gets sent out to our Finom Group contributor, mastermind, and premium members, we basically thought that, technically speaking, the markets were on knife's edge. As you can see, I extrapolated this screenshot from within our weekend research report. It suggests that it presents the potential for downside near term, if not to start the coming week. Essentially, we were, the Nasdaq 100 was below its 200-week moving average. The S&P 500 was teetering on the 200-week moving average. And we have not been able to sustain any oversold bounces. In fact, each of the oversold bounces keeps getting weaker. And we don't have the thrust to get, in order to make higher lows. It's just not happening. So you just get weaker and weaker. And quite frankly, it sets up kind of a crescendo potential for price action in the near term. All you really need is a catalyst, a spark, if you will. So that's where we thought we were coming into this week, as this chart from Thrasher Analytics indicates. The S&P 500 resting at its 200-week moving average just the other day, and to basically start this week. And you get underneath that, bad things tend to happen in the market. And I think that's kind of what we saw this morning. After the CPI report, we saw a crescendo in price action, gap down about 2%, 3% in the Nasdaq. That crescendo in price action. Maybe it set some kind of near-term floor because we had an extremely sharp reversal in the markets. You saw we were green here this late in the afternoon, 2:30. But these bounces have been used just to sell. Every bounce has been a selling opportunity for most investors. So that's where we thought we were coming into the week. We're right now in the midst of literally the longest bear market, without a recession. This bear market now 282 calendar days. You'd have to go back to 2015 to 2016, closest correction with 267 calendar days. So it's been a while. This does feel different because it is different. It is. This is the longest correction. So if you're feeling the pain, trust me, most everybody is. But you got to keep that optimistic outlook because historically, these are great wealth generators. The market is giving you a tremendous discount. I know I've said this time and time again. If Macy's had a 25% off sale, would you run screaming from it? No, you'd be running into the store, picking up the things you need and or want. It's no different in the stock market, especially with the invent of ETFs where you don't have to be a prolific stock picker. Go out there and buy the spiders, buy the Qs, things that are, that the indexes are going to achieve all-time highs in the future. It's not a matter of if, it's a matter of when. Historically, when the S&P 500 is down 25% or worse since 1950, 1 year later, almost always positive. Only time was, of course, the great financial crisis. That's what it takes. It takes an absolute financial crisis, a systemic issue in the financial system. Is that what we're talking about here in 2022? No, we're talking about inflation. We're talking about a derating cycle where, the Fed is raising rates at the fastest pace almost in history. That's not a financial crisis. What about a recession? What do you think the market's pricing? Right? Because most of the time, and the Fed has told us they want to take rates into restrictive economic territory. We see what's going on in housing. Again, what do you think the market's pricing? So down 25% a year later, more often than not, almost all the time, next 12 months, the market is nicely higher. There's your average return. 3 years later, there's your average return. 5 years later, so on and so on. We've shown this chart in various different forms. Another way we looked at it, I think just last week, bear markets, brief periods of time, you take your drawdown like big boys and girls, and you benefit from tremendous upside in the future. Now, right now, we're going to have one of those, down years here. So we got to know what comes on the other side of it. Same thing with the Nasdaq. A little bit different in terms of, the dot-com bubble, right? No earnings. In some cases, some of the business models back in the dot-com period, no sales. There's just the thesis. Pets.com, remember that? So, but still, for the most part, normal economic cycle. We have earnings today. We have better valuations today than the dot-com period. So more often than not, a year later, 3 years, 5 years, 10 years. You got to be buying. You got to be recognizing deep value. The insiders do. Insider buying to selling ratio. Corporate insiders are buying their company stock in size during this sell-off, according to Jury and Tremor of Fidelity. As the saying goes, insiders sell for all kinds of reasons, but they only buy for one reason. It's usually because they know historically that stock is going to go higher over time. Who else is buying? Look at the inflows here. These are annual equity ETF flows. People are still buying equities despite dire sentiment and bear market price action. Having said that, you'll get people to suggest to you that, well, then the bottom can't be in, right? If they're still buying, it hasn't flushed everybody out. It hasn't induced maximum pain. Yeah, sometimes the markets don't, bear markets don't end with a bang, but rather a whimper. This is the latest from Katie Stockton of Fairlead Strategies, her technical outlook, predicated, or I should say premised by the Ichimoku cloud. All of her notes are here, but basically she's saying there's probably support for the market based on the Ichimoku cloud around 3,200. It doesn't have to get down there, but even if it does, Katie Stockton says, it's still a secular bull market. And part of that, 3,200 zone is embedded within our roadmap for 2022 when it comes to increasing capital allocations. We've gone over this several times. Came in handy this week, maybe even today, as we dropped briefly below 3,500. But when we updated this week, because of what we were looking at here, right, price symmetry, sometimes we like to revisit the scene of the crime, as they say. And, you can make the argument that the scene of the crime for the S&P 500 was the pre-COVID high. So we incorporated that 3,400 into our roadmap. This was our primary roadmap of where we would increase our market exposure that we initiated back in July. 3666 would have been basically a double bottom at the time. Back in July, it would have been revisiting 3666. The next area of capital allocation, buying even deeper value, would have been 3558, which is technically I think it was the bear market without a recession. And then bear market with a recession would have been 3260s. So that was in our roadmap, in our game plan all along. But because of this potential price symmetry, we added 3,400s into our game plan as well. What we decided to do was possibly half this allocation, because we still wanted to, buy in that area there in the 3558. It's technically relevant, historically relevant. So we decided to half it there. And then if we did dip below 3,500 and get a 3,400s print, then we could add the other half of that particular tranche in the 3,400s. Just so happened we had a big gap down. So we never got the opportunity to add here. We actually got to add in the 3,400s. Nonetheless, Katie Stockton says support 3,200s. Well, we've got plans to allocate there in case the market wants to find even lower lows. And yes, there's still a high probability of making lower lows. 3,200s is not really something I foresee happening unless we get even greater calamity in the macro fundamentals. Is it possible? Yeah. I mean, we've got this CHIPS bill that just, passed, and we're restricting some of these tech companies from doing their normal business with China. I understand why. It's a defense issue, security issue for the United States. But nonetheless, as an investor, that's going to impact the markets. We had the CPI print come out today. Awful. There's no other way to describe it, folks. Awful. No real relief. minor downtick on a year-over-year basis, and that is not going to, be welcomed by the Fed. We see shortly after the CPI, equity future markets just dumped, down 3% in the Nasdaq, 2+% in the S&P, 2% in the Dow. And at the open, we gapped down pretty sharply. When I was looking inside of the CPI report, again, the biggest problem is they were showing 0.7% higher on, here it is right here, 7.2% higher year over year for used cars. Now, just last week, from the Manheim used car index, we noted we had the first yearly change. Year over year was down 0.1%. We talked about this just last week, and yet in the CPI, it's showing 7.2% year over year. Now, we know there's a lag here. We know that there's a lag, but man, this is the problem with the CPI. The Fed's going to overshoot, whether it's because of rents, which have rolled over for now 3 or 4 straight months on a month-over-month basis, but they're still up 9% year over year. As we've discussed in the past, I'm not anticipating, because of the lag, I'm not anticipating anything good in the way of shelter and owner's equivalent rent within the CPI reading to show up maybe between the November to January CPIs. So maybe we'll get a glimmer of it in the next CPI report. But the fact that this is still not used cars, which are down month over month consistently every single month this year, and now down year over year, is really not having any impact on the year over year in the CPI. It did have a big month over month decline, which may be foreshadowing that we'll see a better number here next month in the October CPI reading. But here we go once again, right? We're moving from one month to the next month, maybe next time, maybe next time. We're too far into this game, and I think the Fed realizes that too. Nonetheless, the gap down in the markets, the pressure on markets this morning is largely due to, well, if the Fed's not seeing any improvement in inflation, then they may have to hike that much more. The projection for the Fed fund terminal rate, where they're trying to get to with rates, was 4.5, 4.6%. But after today's CPI, it's about 4.8, 4.9%. Again, that's what the market's trying to discount, right? Rates shot up, yields shot up this morning. The 10-year yield went above 4%. The 2-year yield got to 4.6 something percent. So yields are, the bond market's pricing in this morning. Equity markets were pricing in. I don't know if you trust this rally. There'll be some people that say, oh, that was the bottom. That was a flush. And it may very well be. There's nothing technically there that tells us it was the bottom. It's all speculation. It could be. But if it's the bottom, the fundamentals will make sure of it. At this point, it's just speculation. Do you care? Do you need to care if it was the bottom or not? In my opinion, no. That's what having a game plan is all about, and thinking long term. Whoops. Having a game plan, thinking long term. Boston Celtics, Yankees, right? My Yankees are in the playoffs. We're starting basketball season soon. Seth, where's your Denver? Don't with my Denver Broncos. I had such high hopes, and they're just all getting dashed. Okay, so until they improve, I'm not wearing them on my bodice. Okay. Anyways, game plan. You don't need to speculate. You just don't need to speculate. Was that the bottom? Was it not the bottom? If you've been managing your cash on the sidelines well this year, think long term. You know the probabilities going forward, with or without Fed rate hikes. At some point they're going to say, this economy is just too strong. The labor market is so strong, which the Fed is trying to upend. We know that. Job openings came way down, which was good. You know, the Fed wants less job openings. There'll be less job hopping, and maybe we'll see some wage inflation curtailment. We actually have already been seeing that. Tweeted out something a little bit ago on that front. We're seeing more of it. This is the Atlanta Fed wage tracker. And as you can see, that's been coming down. We've seen it in the non-farm payroll report also on a year-over-year basis. Wages have been coming down. Month over month, they're still growing, but year over year, they're coming down. And the growth of wages has slowed on a month over month basis, but irritating, right? I mean, down year over year here, but the CPI is just off completely opposing. One of the things I talked about with Finom Group members in our trading room, and again, if you're a premium member and you're not partaking in our trading room experience during the course of the week, you know, you're missing out on some good stuff. We're talking about markets throughout the entirety of the day. We're watching educational videos, whether they're technical, you know, patterns that are being explained by, you know, market participants, certified market technicians, or just clips from a CNBC episode, a Bloomberg episode. You know, every time there's a Fed president giving a speech or an interview, and it's our archive, we want to know. We want to watch it. And that's the kind of stuff we're doing in the trading room. We're talking about our trades, our investment ideas in the trading room. We're going over the technicals. So if you're a premium member, come on, join us in the trading room. Anyways, one of the things I had mentioned during the trading week is in this kind of soliloquy here. Nothing's happened but derating. That's it. That's what most of every part of this bear market is about this year. Fed is raising rates, yields go higher, stocks go lower. The rapidity for which they're raising rates is sending the dollar soaring also. Pile on to it, it's not just our central bank doing it, but it's most central banks. They're all in tightening mode. And everybody knows that most central banks will go too far, and their economy will wind up in a recession. So where do you go to? If you know the history of Fed rate hikes, central bank rate hikes, and them going too far, the safe haven dollar. It's the only thing that's been working. But by and large, that's all that's happened this year. Where's our recession? Well, the Fed's going to push us into a recession. People have been saying that January, March, April, February, May, June, July, August, September. Here we are in October. We're 10 months into the year. That's how strong the consumer's balance sheet is. Nothing's happened, folks. We haven't fallen off the earth. It's just a derating cycle that produced a bear market. We have a different valuation today, a different valuation when yields are 4%. You're not going to get the same equity risk premium. We have the worst equity risk premium since 2008. Since 2008. One of the things that I also say in the soliloquy here, but give it some time, read it when at your leisure. Have U.S. heavy truck sales, heavy duty truck sales. All right, they rose 20% on a year-over-year basis last reported. 20%. We've never had a recession within 12 months when U.S. heavy truck sales have risen 20%. We're looking for just one recession indicator that's fired this year. For the amount of drum beating that the punditry has done, the pessimists, the bears, all year long, recession, recession, recession. Bank of America, right? Just last quarter, they pulled their recessionary forecast into Q4 of this year from Q1 of next year. Just this week, they decided maybe it's not going to happen. So what did they do? They pushed it back out to next year. Nothing's happened this year, folks. Have we had inflation? Have we had a war in Ukraine? Yes. But so far as what's happened to the U.S. economy, nothing. We've got pockets of strength. We've got pockets of weakness. That's always the case. But where's the calamity, right? I mean, that's the whole point. We've had a derating. That's everything that's happened here this year. A derating. The equity risk premium, as I've mentioned before, we've all looked at this chart here. The average equity risk premium going back to 1977 is 2.5%. Do your calculation as of, I think I did this on Monday. And our equity risk premium is 2.2%. Remember, that's on a 4% 10-year yield. Earnings of $224 a share, because earnings have come down. We'll see what happens here as we kick off the earnings season tomorrow in earnest with JP Morgan, Citigroup, and Wells Fargo. I would think that, from $225 down to $224, we're probably going to base here and start seeing 2023. This is for 2022 earnings, maybe even start to rise again. What's most important about this earnings season, obviously, is going to be guidance. Guidance. That's going to be important. But this is the worst equity risk premium at 2.2% since 2008, and it's below the average since 1977. Equities are not attractive. Not today, based on the equity risk premium. But if you're buying today, this isn't going to stay down here, folks. Just like the S&P 500 is not going to stay at 3,600 for the rest of for eternity. You're getting value today. You're getting value. Market yields. This is the 10-year constant maturity, right? Real yields. You hear people talk about real yields, not the 10-year treasury, but the real yields. And real yields, after QE, after the COVID crash, they were deeply negative. And we've heard that the Fed wants to take them into positive territory. Well, lo and behold, not only have they taken them into positive territory, they're at the highest level since 2010. And when real yields are this high, the average S&P 500 return is negative over a 12-month period. If they stay here, because clearly here's 2004, 2005, 2006, 2007, and we know the market was up every single one of those years. We had a positive return. We know that. So this is an average. The average is a negative return since 1983. But there can be regimes where you're still delivering a positive return. Nonetheless, you've heard the term TINA, there is no alternative. Well, now there is an alternative with real yields this high. All right, let's see what else. That's something I tweeted before. Because people blame QE as to why the PE multiples were so strong, since 2009. But the reality is, we spent most of the time with the PE below. This is the average PE going all the way back to 2000. It's 15 times, 15.3, 15.4, going all the way back to 2000. That's the average PE ratio. Here we were, 2009. This is QE. We spent many, many years below the average PE. Got above it for a few years and below it at different correcting points. QE had no benefit when it came to expanding the multiple. If it expanded, it did so because of earnings. All right, something to keep in mind, when it comes to earnings and recessions, because you hear people talking about not just a recession, but an earnings recession, negative year-over-year earnings growth, possibly in 2023. And Goldman Sachs, as we talked about in the past, is forecasting, if it's a recession in 2023, we're probably going to see 11% decline in year-over-year EPS. But if it's not that much, if it's only something like 8% or less, the market was up every single one of these years. Let's see, 1949 right there, S&P 500 was higher. even with the recession. 1953, market was higher, even with the recession. 1980, only 3% earnings recession, market was higher. So just because we have a year-over-year decline in earnings, there's a threshold historically where the S&P 500 can still be higher. I tell you what, even if we do get an 11% year-over-year decline in earnings, if that is coupled with some kind of Fed pivot and we've gotten inflation under control, up, and away, folks. Mark this video, if you will. All right, here's something else I found amusing. Welcome to the Fed's Bizarro World, where good news is actually bad news and bad news is, I guess we'll see. And that's the reality. You know, bad economic data right now is actually what the Fed wants. The Fed wants to see people losing their jobs. The Fed wants to see less job growth, less wage inflation. They don't want you to have higher wages at this point. It's a bizarro world, but that is what it is. And speaking of the economy and people, well, the sales and economy slowing down. By the way, the Atlanta Fed GDP Now tracker for the Q3 GDP period is at 2.9%. We've reaccelerated. I don't know how many times I said that I thought we would see reacceleration of the economy in the Q3 period. And lo and behold, we have the best Atlanta Fed GDP Now tracking results, at this point in the quarter. Q3 is over. We're in Q4. We'll get the first Q3 GDP print, I think, next week. One of the biggest, obstacles to the economy, to corporate earnings right now, is just the difference in spending. Last year, right, what were people buying? They were buying goods, durable goods, refrigerators, couches, furniture, things to go in all the houses that were being bought, right? Well, this year they're not spending so much on goods. They're spending stuff on services, traveling, leisure, hospitality, gaming, events, music concerts. They're going out. They're dining out. Well, my sofa costs about $1,500. It's a big capital goods expenditure for me. But I'm not going to buy a sofa again, the very next year. That's a, once in a maybe 3-year purchase. Now I'm going out. That's $100 maybe. Dinner and a movie for 2. It's a big difference. This doesn't tell me that the consumer's weak. This doesn't tell me that the consumer's strong. It's a different type of spending that's going on, but we can't glean that the economy is weakening or softening. The real problem is this is fewer dollars going through the economy, and it affects corporate earnings, corporate sales. But this doesn't tell us that the economy is weakening, that the consumer's in trouble. It's a shift in spending. All right, some studies, new studies here. Nasdaq, last week, Tuesday, right? We had the big 1-2 day surge. 100% of Nasdaq 100 stocks were in the green that day. Usually, those 100% up days occur towards the end of a downtrend. None actually occurred in bear market rallies since 2008. The average 12-month gain, after you had a 2-day breath thrust like that, where 100% of stocks were up, well, this was actually just Tuesday, where 100% of stocks were up, 12-month gain, and we've got 1, 2, 3, 4, 5, 6, 7 occurrences since 2007. Only one loss in 2007. Only one loss. Now, this signal doesn't show up for all platforms. If you go to stockcharts.com and you look at net advancers, you pull up the Nasdaq 100 net advancers chart, 2007 will not show up as a 100% advancing stock day in the Nasdaq 100. Why? The composition of the Nasdaq 100 was different then. So it's not going to show up. So that's a nuance to these kind of studies also. Another one for the Nasdaq 100. The two big updates to start last week have now been followed by 5 down days in a row. And the 5-day sell-off has put the Nasdaq 100 at a new bear market closing low as of yesterday. So in this study right here from Quantifiable Edges, Nasdaq 100 closes down for exactly the 5th day in a row and at a 150-day low. The forward results the next day, mixed, mostly to the downside, 45% wins or positivity rate. But if we go out 5 days, so from Wednesday yesterday to Wednesday next week, 5 trading days, the market has been green every time. It's been higher than that closing from yesterday, Wednesday. So you probably want to go back and check the Nasdaq 100 and see what the closing value was on October 11th. Or I'm sorry, that would be October 12th. Yep, October 12th. Because we should be higher historically. It's a reasonable sample size here, folks. Goes all the way back to 1990. It's a good sample size. So we'll update this next time for sure. MACD buy signal for technology sector. Right now, as of Monday, actually, the tech sector triggered a rare MACD buy signal, where over 80% tech stocks have had a MACD buy signal within the past 10 days. This chart here from Macro Ops. And last but not least, Larry Williams, trading days of the month for October. It's the best trading day of the month. If you hold a position, if you buy on that particular trading day and hold it for 5 days, the 21st trading day of October, going back 24 years, only 1 loss. If you bought on day 21, hold it for 5 days, only 1 time did you lose. 23 of the 24 times you had a positive return after holding for 5 days. All right, folks, market's looking really strong here. We talked about the 200-week moving average. If we closed here, we would finish the day above the 200 weekly moving average for these S&P 500. Are we out of the woods? Was that the bottom? Has the market priced in all of the bad news, all of Fed rate hikes? Probably not. But stick to your game plan. Think about your roadmap and where you want to allocate. If that was the bottom, good, fine, great. You got your tranches off. Now you need to look for key resistance levels in the market breaking above those key resistance levels with strength. That being said, happy trading, everybody. Be on the lookout for this weekend's research report. We'll see you next time.